All right, welcome to lesson one, formulating your investment thesis. Now, in this lesson, we're going to go over how to create your investment thesis based on your business buying goals. And by the time we're done with the lesson, you're going to have a strong understanding of what factors are important in choosing an actual business to buy. And you're going to have your own prepared investment thesis that's specific to your goals and your skill sets and also the industry right now to take with you when you go shopping for businesses on Flippa. So the first thing to understand when we're buying a digital business or making any investment for that matter, the first critical step to understand is formulating a strong investment thesis is going to set us up for success, not only in the discovery phase and the due diligence phase of buying a business, but it's going to set us up for success years down the line if we do this properly. So you can think of your investment thesis like your personal business buying playbook. So right now we're defining the rules by which we're identifying businesses that we want to invest in and add to our portfolio. So this is going to give you clear rules for evaluating the business. It's going to give you clear rules for deciding which playgrounds you want to play in, which industries you want to go after, which niches you want to go after, and ultimately deciding which businesses to pass on and which ones to pursue. So right now, what we're going to do is we're going to go over the important factors in establishing your personal criteria, as well as looking at industry trends and market trends, and evaluating a business's risks, its strengths, and its future earnings potential, and any other factors that are going to play a role in whether we want to invest in a business or whether we want to pass on the business. We're going to look at market positioning and how that plays into your goals, experience, and skill sets. So let's get right into it. So unfortunately, many investors, they never get past this part of the equation, this formulating your investment thesis part of the equation, because they often try and back out their investment thesis based on what they see in the market. Right? They go and peruse the market and they see what businesses are out there, and then they try to fit their model for what they want to invest in based on what they're seeing. Now, this is the backwards way to do it. So what we really want to do is we want to separate shiny objects that only look good on paper from actual true value businesses that are going to be, give you alpha for your portfolio. So instead of going and seeing what the market has to offer and then formulating a thesis around something that we see in the market, the real successful investors will map out their thesis fully before they look at a single business, because they understand the bias that they'll likely face if they're letting the market tell them what to buy or what is available to buy versus formulating their own buying criteria up front. And so that's exactly what we're going to do in this lesson. Now, personally, I like to boil this whole thing down to formulating my thesis with a 4-dimensional approach. So the 4 dimensions are as follows for me personally. Business, industry / niche, right? So what playground are we playing in? The size of the business, are we going after a $20,000 business or are we going after a $20 million business, right? That's really going to matter. Your risk appetite, right? Is this your first business and you're trying to figure it out and you're trying to, get down a system? Or do you have a portfolio already? Or do you have some cash set aside that, you really want to aim for a home run here? In the realm of buying digital businesses, we really find that the risk and reward are very correlated. So just like most investments out there, you get paid for the amount of risk that you take. So depending on whatever your risk appetite is, right? How old you are, how much money you have set aside, do you have other income? All these factors are going to play a role when determining what your risk appetite is. And then we're going to talk about how to apply that risk appetite when looking at businesses. So we're not picking something that's too risky, and we're not picking something that's, just too risk averse that we're really not going to get any alpha out of it. It's a very big balancing game that we have to play. And then finally, strategy and synergy. So this is a big part in, looking at businesses, because oftentimes, and this is where investors extract a lot of alpha. Oftentimes, multiple online businesses, multiple digital assets are cumulatively worth more than the sum of their parts. So that means, right, you have business A valued at $200,000, business B valued at $150,000. Together, when they're working in unison and when you use them to play off of each other in certain ways, they can be worth much, much more than just 200 plus 150. So we're going to look at opportunities for synergy and different strategies that we could have in accumulating multiple businesses for our portfolio that could be worth much more than the sum of each of their parts. So in addition to these 4 main criteria, there's going to be a few extra considerations that we need to take, such as what is the level of investment that you're looking for, right? And this plays into size of business. Are you looking to deploy a lot of capital, or are you looking to go get financing? Are you looking to, take some equity off of your 401k and maybe do a rollover? Also, what are your cash flow expectations? Is this going to be your full-time thing? Do you need to make a living doing this? Or is this something supplementary for you that you're going to look to grow over the course of months or years and you don't really need that cash flow up front, right? That's going to play a huge role in what kind of businesses you can invest in. What are your appreciation expectations, right? Are you buying this just for cash flow, or do you want to grow this business, scale it, and then exit it in 3 years? If that's a goal of yours, we have to look at things like total addressable market. We have to look at things like market share. We have to actually think about the scalability of what we're buying. Versus if you're just trying to accumulate different sources of cash flow, maybe scalability isn't a huge issue for you. Maybe you're looking for something that has more sustainability. Another important factor that we're going to look at is what your exit plan is, right? So do you want to go sell this in 3 years for a higher amount? Do you want to sell it for the same amount that you bought it at and just, get the cash flow for a few years? And then the final minor thing that we're going to look at is your involvement. So do you want to buy a job for yourself? Do you want to buy something that's a little bit more passive, that has an established team that's already running things? These are very big considerations that we should be taking when looking at businesses, and things that we should decide on before we go out to the market and see what the market has to offer. So throughout the rest of this lesson, let's kind of go down these points one by one and just kind of, figure out what the different considerations are. And ultimately, it's going to be up to you to decide where you fall on each of these criteria and put together your own investment thesis. So the first 4 categories here they're going to give you a much more tangible way to start digesting any listing or prospectus. Now, a prospectus is just a briefing of information that describes the operations, the cash flow, and the general nature of a business. So when I say the word prospectus, I'm just talking about the details of that business, right? So these 4 criteria obviously are going to give you a tangible way to start digesting any listing, any prospectus, and it's also going to give you clear invalidation criteria so that you can move on from businesses faster when they're not a fit. And you're not sticking around trying to figure out whether a business fits your investment thesis or trying to justify why you should continue looking at a business when it really isn't a good fit. And finally, it's going to give you a strong blueprint for what a good investment looks like to you, right? So a good investment is going to look much different to different people. And ultimately, it's going to give you the confidence that you need to pull the trigger when the right opportunity comes your way. Okay, so let's start with criteria number 1, business, industry, and niche. So picking the right industry, it might sound like a no-brainer here, but I really want to start here because you'd really be surprised how often a first-time buyer will try to justify buying something in an industry which they have no experience or they don't understand. However, it's important to note that your experience and skills aren't the only factor at play when it comes to defining the industry constraints in your investment thesis, right? So what this means is basically we want to be playing to our strengths. And so to do that, picking the right industry is probably the most important thing that we can do to minimize our risk as a buyer for 2 reasons. Number 1, you can control a lot more running a business in an industry that you know. And secondly, you have much higher confidence in a business's ability to survive in an industry that is established, right? So an industry that you know or are an expert in, and an industry that is established. So these are the 2 main criteria that we're going to, evaluate each industry or each niche against when we're looking at a business. So based on these 2 factors, I encourage you to ask yourself these 2 questions. Is the business based around something that I know about or have experience or a skill set in? And is this business in an established evergreen industry? And we'll talk about exactly what that means. So obviously the first bullet point here is pretty obvious, right? You know what you have knowledge about and you know where your skill sets lie and experience lies. But for the second one, in an established evergreen industry, really what we want to talk about here is, will this industry still be here in 10 plus years? Or do we have a high degree of confidence that this is an emerging industry that is going to be around for the long haul? Right? So especially if we're looking to make a lower risk investment, fads, trends, and cyclical businesses that have a higher chance of being here today, gone tomorrow, pose a larger risk to you, the buyer, if you can't determine what the future demand is going to be for the business or what the future demand for the products is that the business sells. And so personally, I like to frame it like this. A business with a small market share of a large evergreen industry, right? A big, heavy, slow moving wheel that's really not going to go anywhere is a much better investment, in my opinion, than a business with a larger market share or higher growth in a trending or cyclical industry. And now it comes down to this. You have control over the business. You have a lot less control over the industry itself. And so when we talk about minimizing risk, we want to control as many factors about that business as we can. Now, for some buyers, they're looking for a home run, and that's okay. And that's why we addressed your risk tolerance as a big important aspect here. And in that case, you may be up for a challenge with a trending business. You may be up for a challenge with a cyclical business that has a windfall of revenue around the holidays and a dry spell for the rest of the year. That might be something that you're okay with adding to your portfolio, but it's just important that we understand the risks associated with a cyclical, trending, or some type of fad business. A really good example that I can give you here on a cyclical or fad business is cryptocurrency, right? So cryptocurrency businesses historically do well during election years and the years that follow, right? In years that coincide with the Bitcoin halving. Generally, there tends to be a lot more interest in the cryptocurrency space around those years. And so those years might outperform the dry years by a factor of 4, 5, or even like 10 times. And so the business's performance in those hot years might even outperform the same business's performance in the dry years by 5 or 10x. So if you're comfortable buying a business in the cryptocurrency industry, when the industry is in a dry spell on the hopes that it's going to return, and then when the cycle hits its peak, you're going to really outperform, that's a risk. If you're comfortable taking it, that's a risk that I think would be probably worthwhile, in my opinion. But again, it all comes down to your risk tolerance, and I can't make that decision for you. That's something that you have to decide coming to the table where you want to lie on the risk curve. Okay, now another really important question that we want to ask ourselves here is, could I run this business by myself? Now, this question is a little bit misleading, right? So sometimes bigger businesses that have 5 to 10 employees that are running the show, you may not be able to run yourself strictly because of time constraints. But the important thing to ask yourself here is not whether I have enough time in the day to do all the things that the business requires to continue operations, but do I have the knowledge, skill sets, and background to pick up any of the jobs that need to be done to run this business? Now, it's certainly possible to buy, for example, a cybersecurity business when you have no experience in cybersecurity, right? Especially if it comes with a team. But especially if you're a first-time buyer, it's very helpful to make sure that you can handle any of the business's operations in a pinch. So I like to say, plan for the worst, hope for the best. And if you have the knowledge and the experience where you can realistically see yourself picking up the slack for each and every role in the company, then you're in a much less risky position as a new owner than someone else who would have to be relying on the existing staff's knowledge and skill set and their industry experience. So at the end of the day, industry experience is a buffer to give you more peace of mind, higher confidence, and fewer unknowns. And again, my recommendation as a first-time buyer would be to pick a business in which you have overwhelming experience or overwhelming skill sets. And so once you put these constraints into your investment thesis and you say, I would only like to buy a business in industries A, B, or C, you greatly narrow down your search and your business search becomes significantly easier and less complex. So these two filters alone will eliminate quite a lot of businesses from your search. All right, now moving on to the size of your business. Now, Flippa has businesses listed that range in value from $1,000 to $10 million. Now, that's quite a range. And, to approach the market and say, I'm okay with anything in that range is probably one of the biggest mistakes that you could make, in my opinion, because running a $1,000 business versus a $100,000 business versus $1 million business versus a $10 million business, those are literally, they're all different projects and they're all different jobs. And your day-to-day is going to look quite differently operating a $50,000 business than it is operating a $5 million business, okay? So you have to determine as part of your investment thesis, do you want to start small, get a bunch of experience running something in the 20 to 50K range, and then work your way up? Do you want to buy something small and try to scale it? Or would you rather buy something in the $1 to $3 million range that has an established team already and it's a little bit more passive, although we should be careful about that term passive income, because in reality, passive income doesn't really exist. Now, obviously, the answer is that it determines on your goals and on your investment thesis. Now, this lesson is just as much a goal-setting lesson as it is an investment thesis creation lesson. Now, the two go hand in hand, and they really depend on each other. And so it's important to solidify what your investment goals are. And at this point in the lesson, that's what we're going to do, because the next 3 investment criteria, size, risk appetite, and strategy and synergy, will be heavily dependent on your goals. And now that being said, there are several possible goals behind buying a business, i.e. reasons to buy a business. Now, you could be buying a business for, number one, supplemental income, right? So this would be a scenario where you have some other job or full-time income, but you want to expand your cash flow. You could be buying a business as a store of value. Now, this is a scenario where you want a strategic place to park your money that will also provide steady cash flow. You could be looking for a career migration. Now, this is a scenario where you want to switch career paths. You want to become your own boss. You want to build a portfolio of businesses that become your full-time job eventually and your full-time income eventually, career migration. Another important reason here is outsized returns. Now, you may think your ability to grow and operate a business would outpace any return you'd get in any money market or any other investment. And so in this case, the best possible use for your money would be to buy a business. And then finally, you could have a specific thesis. Now, this is a scenario where you're predicting a market trend or you're seeing a market trend playing out, and buying a business is your way of getting exposure to this trend or to this prediction. And if you're seriously considering buying a business, odds are several of these are going to be a factor for you at least in some way. Now, most people buying a business are doing so for at least two of these reasons. Now, personally, I started buying businesses as a career migration tactic. And now my goals for buying businesses are supplemental income, right? I'm looking to add to my portfolio and outsized returns, right? I think my ability to identify alpha and grow and operate the business is going to outpace most other investments that I could make with that money. So after you determine for which of these reasons you're buying a business, the next step is to apply that to the size of the business that you want to buy. And really quick, I'm just going to add an interjection here. If you don't have $2 million in cash sitting in your bank account, it doesn't mean that you need to discount every business that's $2 million, right? There are lots of mechanisms that you can use. There's SBA financing, there's 401k rollover, there's different equity partners, there's debt financing, there's different ways to finance this business and get the deal done that don't require you coming up with $2 million in cash, right? So we're going to talk about all of that in a future lesson. But just so you know, at this time in the lessons, you don't need to be discounting businesses just because you don't have the cash to buy it. So that's something important I thought I'd add. Okay, so moving on to criteria number 3 in your investment thesis, your risk appetite. Now, one of the most important considerations, like I said, in formulating your investment thesis is where you're going to fall on the risk curve. Now, with any investment, you're getting paid for taking on the risk and being correct. Now, it's important to determine what your acceptable level of risk is before shopping for businesses. And again, this is not something that I can teach you. I can't teach you what your risk tolerance is. I can talk about the different factors, which are your age and where you're at in your career, your financial position, right? Your cash position, what assets you have, your asset position, your net worth. That's an important factor in determining your risk appetite. And then finally, again, what your main business buying goals are. And that goes back to the 5 goals that I talked about. If you're buying a business for supplemental income, you can probably be a bit more risky if you have another income source somewhere else, right? That you don't have to rely on this new business for all of your income like you would in something like a career migration. And so this is the kind of thinking that we really want to deploy when we're making our investment thesis, right? Much of this lesson is not quantitative, it's more qualitative. I'm just getting a feel for what kind of business we want to, make our way into and what the important factors are in choosing a business. It's a lot more nuanced than just saying it's either a 1 or a 0. And now finally, the last consideration, criteria number 4 that we will consider when we're trying to, figure out our investment thesis is strategy and synergy. Now, this is especially important if one of your investment goals is to build a portfolio of businesses. Now, like I said, oftentimes owning multiple businesses in the same portfolio can be worth more than simply the sum of their values. And this is one of the biggest reasons that people actually buy website businesses, especially on Flippa, to bundle them together and to take advantage of synergy. Now, for example, let's consider the following 2 businesses. Business A is a newsletter geared toward people who want to grow a following on social media. The newsletter has 50,000 subscribers and monetizes by selling a $99 course. The business makes about $100K a year after expenses, and the asking price is $300K, so it's a 3x. Business B is a content creation agency which scripts, shoots, and edits content for its clients. It has a small social media following and a 7 high-ticket clients, and this business makes $150K per year after expenses, and the asking price is $450,000, another 3x. Now, quick side note, when I just say 3x, I mean the valuation is 3 times what the business makes in a year after expenses. When we talk about valuation in a future lesson, that's going to be one of the biggest things in determining the valuation is what the multiple is. So in this scenario, buying business A and B separately and individually would cost you a total of about $750,000. However, the nature of the businesses are complementary. And a simple strategy here with businesses A and B would be to sell the agency services to the traffic generated by the newsletter. Now, in addition to the revenue that each business is already generating, the cross effect from owning both of these businesses would likely make owning both businesses together more valuable than the sum of owning A, which is, as we determined, $300,000, plus the sum of owning B, which is $450,000. So likely you'll be able to extract more revenue and therefore more profit by owning both. This is a very basic example here. And the questions you should be asking yourself for this criteria are, is there a reason for the business I am looking at to be more valuable in my hands than the average person, right? This is personal synergy, right? Do I bring anything to the table that would give the business an advantage or help it perform better, right? That's synergy between you, the owner, and the business itself. Another thing to ask, what are the business's strengths? And do I currently own or do I plan on buying a different business that could benefit from those strengths? So that's extracted value. Can I extract value from this business that would enhance another business that I own or may own in the future? What are the business's weaknesses, or what are the reasons why it may be underperforming? And do I own, or again, do I plan on owning another business which could compensate for those weaknesses? So that's added value. Can I take this business that is underperforming for reasons A or B, and do I have anything to add to that business that when it's in my hands would make it worth more money or make it make more money? This is the type of thinking that we have to engage in when looking at these businesses. Now, if you come to the buyer's table with a specific synergistic combination in mind, your search becomes much more defined and you can quickly narrow down your shortlist while staying clear on what your buying requirements are. All right, so again, to summarize and review, your investment thesis is a function of the following 4 criteria: the business, industry, and the niche, the size of the business, your risk appetite, and any strategy and synergy objectives that you have. Now, one thing to note, on Flippa, your profile has a section to fill out a buyer mandate. Now, I suggest that you do this before starting to search for businesses. I suggest that you fill out your profile, including your buyer mandate, because this is going to achieve 2 things for you. Number 1, it'll help you remember exactly what you're searching for. It'll be there the whole time so you don't get off track. And number 2, it is going to help sellers and Flippa staff find the right businesses for you. So Flip has brokers that they employ that are always searching for the right matches between buyers and sellers. And if you fill out your buyer mandate, it's going to make their job a lot easier. So when filling out your buyer mandate, I suggest that you address each of the 4 main criteria that we went over here in this lesson. Now, for example, here's mine. It said looking for a quality newsletter or other traffic-centric business in the entrepreneurship niche between $500,000 and $2.5 million. Very specific. You can take any business that's listed on Flippa and within 2 or 3 seconds know if it's going to fit into this thesis or not, right? And that's the goal. We want to be able to move on from businesses as quickly as possible, and we want to be able to identify the businesses that match our thesis as quickly as possible so that we can make this process very efficient and we can have high confidence when we're analyzing and looking at a business to buy, okay? Okay, so in the next lesson, we'll be moving on to the stage where we begin to look at individual businesses with our investment thesis already prepared and our buyer mandate in place. So grab a coffee, grab a water, whatever you need to do, and I'll see you in the next lesson.